Hello and welcome to a special edition of the Troutman Pepper Consumer Finance Podcast, where we discuss all things driving litigation and enforcement actions in the world of auto finance. I'm Brooke Conkle. I specialize in litigation, and I'm joined by Chris Capurso, who specializes in all things compliance. Today, we're going to discuss recent developments in ancillary products, which have been a hot topic for regulators for close to a decade. So, Chris, let's start at the very beginning. What are ancillary products?
Yeah, Brooke, and I feel like it changes, but the big ones that you think of are guaranteed asset protection, which is one we're going to cover a lot, as I'm sure anybody listening to this podcast knows, or GAP, vehicle service contracts, extended warranties, credit insurance in the case of a finance deal, or it could be products for the car like mud flaps or the cargo net, or, the things that are added to the balance when you purchase a car. And sometimes those are financed, sometimes those are paid in cash, more often financed. And they're additional products that sometimes they're called ancillary products, sometimes they're called add-on products, sometimes they're called vehicle protection products. There's all sorts of names for them. The buzzword at the moment is ancillary products.
Yeah, Chris. And as you mentioned, GAP really has been kind of the focus of scrutiny from federal regulators, state regulators. Everybody is after GAP. And when we talk about GAP internally, we tend to think it's a good product, don't we?
Certainly. To kind of explain what GAP is, it's an acronym that works very well because it does somewhat explain what it does. Say you have a finance deal, so you have a retail installment contract or a separate loan or something to pay for the vehicle, and say it gets totaled. And then your insurance company comes in and says, oh, well, it's worth this much. The problem is this much, quote unquote, is worth less than what you have on your balance for your finance contract. GAP will waive or cancel that remaining gap. Lack of a better word, it's a perfect acronym, the gap between those two numbers. And when we're talking about gaps, there are really two different types. There's gap waivers and gap insurance. And gap insurance is a separate animal. One, it's insurance. Two, it's going to be provided by a third party that is licensed to do insurance in a state. Whereas a waiver is really, we call it a two-party deal. Usually there's going to be like some kind of administrator on the gap, but the gap waiver is sold at the time the car is sold and it's financed in the transaction. And one key thing with the gap waivers, and this is something everybody is overjoyed to hear, is that state gap laws say that gap waivers are not insurance regulated by the insurance code, which is something, all of us consumer finance lawyers love because the insurance code is like that shadowy area that we stay away from outside of credit insurance, of course. And it's also good because obviously insurance has a load of requirements, a load of licensing problems, and a dealer selling a gap waiver certainly doesn't want to be getting into that. They're already regulated enough as it is. So that's one of the big differences between like a gap waiver and gap insurance. And these gap laws I mentioned, there is like a uniform gap law that's out there that many states have adopted. And much like any other uniform law, the one that's coming to mind is the Uniform Consumer Credit Code. It's all great until somebody makes one change. And then all of a sudden you've got 15 little variants running around where some of it's the same, some of it's different. But these laws will typically have a free look period, which is after the deal is done, the consumer gets a certain amount of time, like 30 days, to basically use the gap, and they can cancel it in that period and not incur any cost. Most of the laws are going to have that. It's what happens after that can be a little bit different from state to state. I know, for example, Virginia, our home state, they permit gap waivers to be cancelable or non-cancelable after that free look period. And other states, Maine is an example, it has to be cancelable. So the consumer must be able to cancel the agreement. Here in Virginia, you can say it's non-cancelable. One interesting part of that is, and this is where the regulatory focus comes in, is, okay, we're talking about these waivers that are specifically for a finance transaction to remove that gap amount. What happens if the person pays off the contract early or their car is repossessed? Unlike, say, an extended warranty, you're not going to be able to use that anymore. The finance aspect of the transaction is gone. The car might be gone too if you had a repo, but the finance part of it is gone. So what's the benefit? And that's what a lot of regulators are looking at. And that's also different on a state-by-state basis. Most of the state gap acts do say You have to provide a pro rata refund depending on how long the contract was actually in place. But some states, our home Commonwealth of Virginia, says that you can have a waiver provision that says, no, we're not going to refund, but it has to be in there. And that's kind of another interesting compliance point is, these waivers are their own documents that have their own requirements under these gap laws. And it's another document the legal counsel should be looking at and making sure that when it complies into it says all the things you want it to say. But these refunds are really the big focus of regulators recently.
So we've talked a lot about GAP, but ancillary products encompasses more than just GAP. What else is included?
Yeah, so we've discussed, vehicle service contracts, extended warranties, which, as any compliance attorney will love to say, an extended warranty isn't really a warranty because it's not a basis of the bargain and it's something you buy separately. Always a fun distinction. But those types of products, which, as I mentioned, aren't tied to financing specifically, they're tied to the vehicle purchase. The benefit can extend beyond the finance contract. If I got a 6-year retail installment contract and paid it off in 3 years, it does nothing for my extended warranty. It's still useful. But my gap, if I have a gap waiver, that's where the refund problem comes in. And then there's also credit insurance products. If you get sick, if you lose your job, dealers will sell credit insurance products that can help pay the balance if one of those events occurs. It's another thing that you finance with the contract. And it's another ancillary product that is regulated at the state level. I had mentioned uniform consumer credit codes recently. Those have specific provisions in them for credit insurance. State Retail Installment Sales Acts will also have provisions regarding credit insurance, and that's a state grind. Usually the insurance provider in that case would have done that kind of diligence, but all these products can be regulated in different ways, can be subject to different cancellation and refund requirements. And it's a big universe of compliance risks and different products.
Yeah, as you mentioned, really what a lot of regulators are tending to focus on is really the value of that add-on or ancillary product. And we've talked a lot about the FTC's recent submission of the CARS rule. And there's a lot of uncertainty about the CARS rule. It's being challenged in the Fifth Circuit. Whether or not it survives is still an open question. But Chris, as you mentioned, one of the major focuses for the FTC is ancillary products and add-ons. And what the FTC has targeted in the CARS rule is this idea of valueless add-ons. And some of the commentary specifically in the CARS rule suggests consumers get home after they've bought their new car, used car, they've made that purchase, they get home and they look at the contract and say, wait, what did I buy? What is this line for an extended warranty that I didn't know I was buying? And what's really interesting and frankly, probably going to be really burdensome on dealers is this idea that dealers are going to be responsible for ensuring that consumers do not buy a valueless add-on. And one of the items that is specifically called out in the CARS rule is a gap contract that exceeds sort of the loan to value ratio of the deal. So for example, if a consumer buys a gap waiver, but really it is never going to be underwater in the contract, then the FTC would consider that a valueless add-on, and the CARS rule would prohibit the sale of that gap waiver. One of the other examples that the FTC gave of a valueless add-on is a separate vehicle warranty add-on that a consumer can purchase, an extended warranty that covers the exact same issues or exact same vehicle parts that the CARS standard warranty covers. So at the dealer level, there's going to be, if the CARS rule, survives, if the challenge is defeated, then there are going to be a lot of decisions really at the dealer level on how to market ancillary products, how to sell them to consumers, and how to make sure that consumers are fully informed about both the benefits and the limitations of ancillary products. So, Chris, with this sort of background, have there been any recent regulatory enforcement actions that target the sale or marketing of ancillary products?
Sure, and there have. The CFPB this past year said that not refunding gap waiver costs upon repossession or early payoff could be considered an unfair act or practice, which is sort of always we warn clients. There's the law and the statutory law, and it may say whether something is or is not permissible, but there's always that boogeyman of UDAP. Like, even if the law doesn't say it, you can say it's unfair, you can say it's deceptive, you can say it's abusive, and it's not quite the enforcement by blog post that it used to be, but it's still kind of the specter, the cloud that UDAP action is hanging over. And this is just one of those cases. The CFPB just said, not refunding it, not pointing to a specific state law. They point to the Consumer Financial Protection Act and say, no, this is unfair. And obviously, state AGs have that same UDAP authority. And actually, Colorado is a good example of a state that has also gone after not refunding gap waivers. So, this is, with the CFPB looking at it as an unfair practice, this is something that opens it up, beyond any specific state statute, but also to state AGs to potentially enforce if their state's gap laws are a little bit more lenient, shall we say, regarding refunds. And some other regulators, you just know it's on their radar, like New York Department of Financial Services released a letter now almost a year ago, last July, reminding folks that if somebody has a gap waiver and, the contract gets cut short, pro rata refund should be considered. The CFPB has also sent a similar reminder, this one a couple of years ago now, saying, you should refund in the context of deficiency balances, like trying to figure out, okay, somebody's been repossessed, what's the deficiency balance? The CFPB says you shouldn't be considering unearned gap waiver costs. So it's definitely on regulator radars right now, especially gap.
Yeah. Chris, what's really interesting is that in the recent sort of supervisory highlights, one of the areas that the CFPB mentioned really was kind of going back and looking at what dealers kind of have a higher percentage of sale of ancillary products. Is that kind of a warning sign for auto finance companies? If you have one dealer who has kind of a disproportionate number of sale of ancillary products, maybe that's a red flag for an auto finance company that something could potentially be going on at the dealer level that maybe both the regulators and the auto finance company would not be comfortable with. I know we both kind of sound like we're beating a dead horse with compliance, but it's that complaint management specter, making sure when complaints come in that they're addressed and really kind of evaluated. Is one dealer getting a lot of complaints about one particular add-on in particular? Is one dealer getting a lion's share of the complaints about processes that are at the point of sale? Is there one product in particular that consumers, frankly, it doesn't seem like they feel comfortable with post-sale? That sort of management, that compliance, that post-sale review that auto finance companies can engage in really can mitigate your risk and keep you out of the eye of the federal regulators.
That's a great point. And your first point about, does the dealer have a disproportionate number of consumers getting add-on products? At their base, all of these are supposed to be optional products. The consumer is supposed to have the option of purchasing them. If a dealer has a disproportionate number of consumers buying the products, it could lead into a theory that maybe they aren't so optional. Maybe there's been some sales pressure. Maybe there's been some potential deceptive acts fitting perfectly into the D and UDAP. Where there's smoke, there could be fire. And like Brooke said, if the CFPB is out there and the regulators are out there looking for kind of this disproportionate number, above all else, they want consumers to have choice. I mean, why does the CARS rule have express consent on these things? Choice. Why does, if you look at a California retail installment sales contract, it looks like a billboard with all of the different disclosures that you have to have for every single type of ancillary product and every type of disclosure out there, because they want consumers to have choice. That's one of the biggest red flags I can think of, is if there's any kind of smell or sense that maybe these products are being portrayed in a way where they're not optional, where they need to get them to get the deal across the line or to get financing or any of those types of things. Those are big red flags.
That's exactly right. And as you mentioned, the regulators are looking for outliers. They're looking for things that are sort of different than the average. So for auto finance companies, if the federal regulators are looking for that, you should be too. That should be your best sort of indication that there could be a problem.
Absolutely. And with that, that concludes another episode of this special series on auto finance, the spinoff of the Consumer Finance Podcast. I was joking earlier that we are the Frasier to the CFS podcast. Cheers, which is great because we're both just wonderful. So what you'll want to do is you'll want to go to whatever podcast service you subscribe to, whether that's Spotify, Apple, subscribe to the Consumer Finance Podcast, but also to any of the other wonderful podcasts that Troutman Pepper offers. And until next time, this is us signing off.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.